Hello and welcome back to Core Finance. I'm Matt Brown. This is the second of 3 videos today with Nicole Elliott, and we're now looking at the Aussie. So talk us through the chart you've kindly brought along today.
Well, at last it's getting interesting, Matt. At last, since July, we're doing something. And what we're doing, or what we've done, and I think there's a lot more to this, is that we've broken out above the top of this symmetrical, almost symmetrical triangle that has dominated for 2 whole years. I mean, 2 whole years of this slog where the moves are big enough to get you worried, but not drastic enough to make you have to take action, isn't it? You sort of, and this one you can see is leading in that we've been holding above the top of the Ichimoku clouds, and the clouds are now supporting the Australian dollar against its US counterpart. So whereas the cable was stuck on the big black one still, this one's got a little bit of lift and a little bit of gear and a little bit. Moving averages that go with the system are up. So it's not fantastic, but it does look good in that you broke above the top of the triangle, pulled back a little bit thinking, oh, am I doing the right thing? But kept above the triangle. That's the important bit. So now for a long-term investor, I would suggest looking to buy the Aussie and using that as your stop loss. Now this week we've sort of stalled just under that horizontal red line. Again, that's a 50% retracement level from a high in 2014. So it's a longer term move than the cable one. But I think there's every chance that between now and Christmas we'll bust through that level. It won't take much to get to it. And let's not forget that interest rates in Australia are marginally higher than in Europe and the US. Their cash rate, as it's called, is 1.5%, and it's been there for some time. That is, by the way, a record low for them.
Yes.
It is a record low, but it's a bit more than 0.25%, isn't
Exactly,
it?
as we have in the UK.
It's multiples, 6 times as much.
And this is being driven as commodity play, obviously a commodity currency. So China actually seems to be performing, albeit the data's a little bit mixed. It seems a currency finally in favour.
Well, commodities have been in favour. Again, much to a lot of people's surprise, who keep banging on about this China slowdown. And yes, it has slowed down, and infrastructure investment and so on has slowed down. But commodity prices are actually fairly firm. They're not at record highs. They're nothing like the sort of bonanza levels we got to in 2008 and 2011. But there is a generalised bid tone to the things that matter to Australia, like coal. You know, not so much the foodstuffs, those are different. Those are in a world of their own. But definitely the base metals and things like that, aluminium, steel, there's a bid tone to it. It's not a runaway thing at all. So obviously that will give a little bit of a lift and a fair wind to all things Australian. And we can see that in their job numbers today. Once again, very low unemployment, lots of jobs created over the last month, the sort of things that you, as a politician, would give your eye tooth for.
Yes, indeed. So as you rightly said, the trade here possibly go long, but placing the stop down near the...
just under 78 cents,
just
under 78 cents, yeah.
Understood. Perfect. Thank you, Nicole.